CNBCTV18.
Hey folks, it's the weekend and we're back with a brand new edition of Smart Money, and this is a Women's Day special, so happy Women's Day to all our viewers. Today we're going to talk about one topic that has been of interest lately. Everyone's been wondering about the stupendous rise that we've seen in a lot of American or US companies, right? Whether it's Apple, Alphabet, Facebook, or even Tesla. Have you ever wondered how you can participate in that rally? How can you invest in international funds or international stocks and make the most of the rally that we're seeing there? That's our topic for today. What are the merits and demerits? Our expert today, Radhika Gupta, the MD and CEO of Edelweiss AMC, joins in. They have some cracker funds that have exposures to international stocks. So let me go straight to her. Radhika, happy Women's Day to you, and thank you so much for joining us on the show today. That's the first question, right? As a retail investor, what are the benefits of investing in international funds, especially in the current scenario?
Hi Sonia, wishing you and your viewers a very, very happy Women's Day. I think international investing was inevitable, and I would outline three benefits for the Indian investor. The first and most important benefit, Sonia, is diversification. Just like India portfolio, you have debt, equity, gold, various different asset classes, because different asset classes perform at different times. Different countries also perform well at different times. There could be a year when US does well, there could be a year when China does well, there could be a year when India does well. So the single biggest reason to hold international funds is the argument of diversification. Adding international funds reduces risk while increasing returns in your portfolio. The second is, and you alluded to the US, is access. There are lots of things that we consume. You know, we're consumers of Apple phones, some of us buy Tesla, we're consumers of Visa and MasterCard, but many of these companies are not listed in India for whatever reason. So many of the themes that we as consumers use that are changing the world are listed abroad and can be only accessed abroad, especially in areas like technology and healthcare. And I think finally the third theme is currency. The Indian rupee depreciates at about 3 to 4% a year, and by investing in a foreign currency, you benefit from the rupee depreciation. All in all, it also has become very easy, as you said, through the international mutual fund platform.
Okay, so let's go straight dive into the three funds that you guys have, the three prominent funds that have exposures there, right? So I just want to pull up a plate to show the performance that some of your funds have seen. There's a US tech fund of funds, and we'll talk about the merits and demerits there. Incidentally, today is the 1-year anniversary of the launch of that fund in India, and it's given an 81.8% return in the last 1 year. Just look at that. They also have a Greater China fund that I'm more interested to talk about given the situation. It's a 69.1% rise that the Greater China Fund has given in the last 1 year. So these are the kind of returns that you could have made if you had invested in these funds a year ago. So let's talk about it. Is it too late, Radhika, to invest in the US Tech Fund, for example? And let us talk about that fund itself. I mean, what does the fund entail? What kind of exposure would you have? And how does a retail investor benefit?
Sure. So the US Tech Fund was launched a year ago in March, as you said. It was a very different time for the world, and there was a lot of pessimism. And I think investors have done well. I think the US Tech Fund fundamentally addresses a theme that got accelerated during COVID, Sonia, which is that technology is changing all our lives. And I would say, while it's called US Technology, it's not a sectoral fund, because technology is affecting every industry, whether it is cars, whether it is financial services, or whether it is entertainment. This is a fund that is run with our partner JP Morgan, and it's got a long history overseas that aims to benefit from disruptive technology themes. So it holds a diversified basket of about 60 to 70 names, and these are companies and ideas that are at the S-curve of technology. So they're not ideas where penetration is so high that there's no scope for growth, like your tablets or hardware, and they're not so new in terms of where, you know, the technology is not tried and tested. So the big themes that you see in a fund like this are autonomous cars. I mean, we've all heard the Tesla story. Streaming, because Netflix and Amazon and companies like that have kept us busy through the lockdown. Digital payments, we've heard the story in India. It's also an important story in the world. Semiconductors, cloud computing. and 5G. So these are the 5 or 6 mega themes, and through the fund, an investor gets access to these sort of disruptive companies in the US.
Okay, so you spoke about 5 or 6 mega themes, and we'll get that chart up for you on the screen as well. You know, the digital theme, the OTT theme, the semiconductor theme, the auto theme as well. But you know, the question that I have is, there's one problem, right? How do you combat disruption? Because technology gets redundant before you know it. I mean, if you look at it, say 20 years ago, Xerox was big. Today, Xerox is nowhere. How does one use that in your favor, and what are the merits and demerits of that? I mean, redundant technology.
So I agree, and I think which is why it's important that this is an actively managed fund. In fact, if you look at the top 10 tech companies by market capitalization, Sonia, from the 1980s to now, they have changed completely. The top 10 today and the top 10 in the 80s are completely different. In fact, if you look at those from a decade ago, only 2 overlap, because the 80s were a decade of mainframes, then there was a decade of PC, then there was an internet decade, then there was a mobile decade, and now there's a sort of AI decade. So it's very, very important that the fund is actively managed. I also highlight that because people look at technology and say, could you do this as a passively managed fund? The way we manage this fund is very, very active. In fact, one of the edges in technology is catching important themes early. And one of the reasons this fund has also been able to deliver substantial outperformance over its NASDAQ benchmark is that it catches themes early, and those themes typically take 6 to 12 months to later hit the benchmark. So active management is very core to a category like this.
Okay, so you know, on your screen now you are seeing some of the big themes, right? There's robotics and electric vehicles, there's energy, there's industrial. So take us through that plate, Radhika. What are the mega trends that I, as a retail investor, can get exposure to if I invest in this fund?
So I think I talked about 6 trends, but I'll give you just an outlook of 3 interesting themes that the fund is looking to play additionally. One is the whole supply chain to electronic vehicles. We've all heard the EV story. Everyone knows about Tesla, but companies that are part of the supply chain. The second is within industrials. You know, the whole theme that you mentioned, and we've got a number of names in that space. The third theme actually is a digital advertising theme. So we've added a company in the portfolio that's set to benefit from digital advertising in 2021. They've got smart screens. They're one of the largest producers of smart screens. There are also interesting themes that the fund is playing in areas like healthcare and diagnostics, so healthcare technology. Social networking continues to be one of the themes of the fund. AI for financial services, these also continue to be some of the themes for the fund.
These are the big themes, but let's talk about the stocks as well, right? I mean, we all know about the Apples and Teslas of the world, but if I'm investing in this fund, what are the different kind of stocks that I would have an exposure to?
And I'm glad you mentioned the whole FANG and Apple and Tesla, because a lot of people think that US technology investing is restricted to FANG and Tesla. This fund is not a FANG and Tesla fund. It doesn't want to be a FANG and Tesla fund because we believe that technology is inherently risky and it needs to be diversified. I'll take you through 3-4 interesting ideas that the fund holds that you might not have heard of. One is a company called Dexcom. It produces glucose tracking equipment. As you know, a large percentage of the US population has diabetes. In fact, it's slated by 2020 that 1 in 3 individuals in the US will have diabetes. So Dexcom plays that space. There's a company that people may have heard of called NVIDIA, which supplies to gaming companies. It's one of the largest producers in the GUI space. So NVIDIA is another company in the portfolio. Many people in the Indian context would also know that banks and credit card companies look to do a lot of analytics. There's a company that we've got called Cardalytics that's got AI-based tools that works with credit card companies. And finally, I think this is an interesting one. There's a company called Match.com that this portfolio has held. Match is the holding company of a well-known site called Tinder, where incidentally Asia is one of the fastest growing markets. So it gives you a sense of the range of themes and stocks beyond FANG that the fund is really looking at.
Okay, so financial financial technology, tracking of diabetes. You spoke about Dexcom. There are some other very interesting names. So if you can take us through what these companies do. There's Teradyne, there's Synopsys, there's Analog. Are these sort of new and emerging technology companies? And if you can share some more details.
Yeah, so if you look at all the three companies, they're either semiconductor companies or they're in the industrial testing space. The first company you mentioned, for instance, has clients like Samsung and Intel. They're actually not new companies. Many of these are not new companies, but the whole theme around semiconductors, the whole theme around services has really picked up. In fact, that's arguably one of the themes of the decade, and that's why you're seeing them in the portfolio.
All right. Well, lots of stocks actually that you've spoken about and lots of big emerging themes, technology themes. There's this misconception, as you said, that if you invest in tech companies in the US, it's all about the FANG stocks, it's all about the Facebooks and Apples. But we've busted that myth. We've taken a deep dive into what these funds really mean and what technology you'll be exposing yourself to. But let's do one thing. Let's take a short commercial break. Don't go anywhere. When we come back, we will also track the emerging market fund. So not just the US, but you can have an exposure to many emerging markets along with the Greater China Fund. That's been the interesting one. Be back in a bit. Welcome back. You're still watching Smart Money on CNBCTV18. This is our special Women's Day programming on, we're talking about how to invest in the international markets. How can you have an exposure to developed as well as emerging markets apart from India? Radhika Gupta, the MD and CEO of Edelweiss AMC, has been speaking to us. Radhika, before the break, we talked about exposure to US companies, to technology companies. What about the Asian and emerging market region? You have an emerging market fund as well. Tell us a little bit about that.
So I think it's very important that we actually talk about emerging markets, because while the last decade, Sonia, has been a decade of developed markets, there are high chances that this decade could be the decade of emerging markets, especially in line with sort of improving macros in emerging markets and potentially a weakening dollar. I always tell people when they're looking to do international exposure that they must have one developed markets fund, but they must have a play in emerging markets. Emerging markets obviously benefit from a favorable demographic. They are a high risk, high return investment play. But besides India, just as India has a very strong story in consumption, in financial services, in technology, emerging markets too. In fact, they're at the forefront of some of the work in technology. The Emerging Markets Fund in particular is a diversified fund that looks at opportunities across emerging markets. So it will look at China, it will look at Russia, it will look at Brazil, India, and to a smaller extent, countries like Taiwan. And the themes are themes that you would be familiar even in Indian funds. Themes around consumption, themes around financial services, themes around technology, and to a smaller extent, themes around internet.
Okay, I noticed that you have names like HDFC, Tencent within this fund. So just take us through what are the top 5 stocks that the fund has an exposure to and what has the past performance been like?
Sure. So I think while emerging markets in terms of performance have had a weaker decade, and I always say past performance, whether it's the 80% in US tech or the tricky time in emerging markets, should not be a guide to the future. I really think international funds are about asset allocation. In terms of stocks and themes, let me take you through a few of the big ideas. As you said, technology continues to be a big theme. Many people will be familiar with a company like Taiwanese Semiconductor, which is the largest in its space. And of course, most Indians are familiar with Samsung. So those are two big names in the technology space. We have two large internet plays from China, that's Alibaba and Tencent. Just like you mentioned, HDFC on the financial side, one of the largest Chinese financial services plays is a company called Ping An. And we also have a commodities play that is Lukoil, which comes from Russia.
So for these stocks, names like Tencent, Alibaba, this has been a great decade for them. But who is to say that things change very fast, right? We've been talking about disruption. How do you make sure that you're swift on that move? I mean, do you churn the stocks quickly within this fund? How does it really work?
Okay, so this is not as high churn a portfolio as emerging markets. There we are as the technology fund. Technology, of course, because of the nature, will be a very, very high churn portfolio. This is broadly like a diversified fund. So there will be a change in allocation between countries depending on the fund manager's view of different markets. So if you're overweight China, your exposure to China will tend to go up. But China will remain a large part of the fund, for instance, because it's a large part of emerging markets. And then within that, you're really identifying themes, but it's broad-based. So the churn is significantly less than a theme like technology.
Okay, in fact, you know what, Radhika, we're getting a lot of queries from our viewers, so I just wanted to throw one of them at you. Praveen Bhandari has written to us on Twitter. He says he wants to know the ideal percentage allocation for foreign investments and the type of assets to pick for short and long-term investors. So if you have, say, 100 rupees, how much out of that should you allocate to some of these foreign funds? What would your advice be?
So tricky one. I think you should definitely start with 10% because you have to start with a meaningful amount, and the allocation could go to 20-30% of your overall portfolio. Obviously, if you're a more aggressive investor, that number will be closer to 30. If you're more conservative, that number will be 10. It's important because you use the words short and long term, Sonia, that we remember that when we invest in international funds, they are long term holdings because ultimately you are buying equity, and whether it is Indian equity or Chinese equity or US equity, equity has the same nature. It is volatile. It needs to be long term. So I definitely recommend a 5 to 7 year horizon. And on the question of how to do your allocation, I think there are a lot of options out there beyond even our fund house. I would definitely say have one piece of developed markets exposure and one piece of emerging markets exposure. That's what I do with my personal funds as well.
Okay, that's some great advice. There's finally also an Edelweiss Greater China Equity Offshore Fund. Now, what is the kind of exposure that I would have there? Would it be very different from the Emerging Markets Fund? And what are the businesses or technologies that you guys are exposed to there?
So the difference between this and I think China has been one of our most popular funds is that this is a Greater China fund, so China, Hong Kong, Taiwan, and it's a really growth focused fund. So it's best of 50 to 60 ideas from the Greater China region. The sectoral themes tend to be similar. I would just make a point about China. I think China investing has changed colors over the last decade or so. There was a point in time when China as a country was seeing tremendous economic growth, but it was largely driven by state-owned companies which were poor in terms of ROE. So you were seeing the country grow, but you weren't seeing returns. That story is changing a little bit now with the introduction of A shares, and I think Chinese investing is becoming very similar to investing in India. The themes are the same. The themes are growth, the themes are consumption, the themes are technology, the themes are financial services, and that's exactly what we do in the fund. So I think, to the question that was asked before, between emerging markets, which has a cross-section of countries, or China, you have two very interesting emerging market options, and you can pick one of those.
Okay, and finally we're getting one last query, so I just want to toss this to you. Chandresh is writing to us. Is mutual funds the only way to invest in international markets, or can we directly invest in global equities as well? If yes, how and what are the tax implications?
Okay, so I'm not going to be a tax expert on overseas markets, but I can comment on mutual funds. Yes, you can invest in overseas markets via the LRS route. In my understanding, there is a 5% withholding tax when you do that, although check that. In mutual funds, the thing is, it's very simple. You can start with 5,000 rupees. The taxation is debt taxation. And a lot of people, by the way, Sonia, forget that you have the benefit of indexation. So you end up paying 10-15% tax on these portfolios. Call me biased, but I think there's a tremendous benefit to using the mutual fund route just because you don't have to study so many markets. It's hard enough to study a portfolio of 50 to 60 Indian companies, let alone Chinese or Brazilian ones.
And that's why we have experts like you to guide us, right? And to make sure that we take the right path and the correct route to sort of our investments. But Radhika, it was a pleasure speaking with you. There was so much to learn on this episode. And I'm sure people who, were wondering, were trying to grapple with how to have an exposure in international funds have got their answers on this show. Thanks so much for joining us. And with that, it is a wrap on another special edition of Smart Money. You guys have a great weekend.